COVID has been over for 4.5 years, and we've completely gotten over social distancing. So can I ask everyone at the back to come forward? Let's get closer together. There's a lot of VIP seats available as well. All right. Distinguished guests, ladies and gentlemen, good morning, and welcome to the final day of the 48th ICA Conference and Exhibition. For those of you who attended the gala dinner last night, I heard you all had a wonderful time. Did you? Smiles? Awesome, great. And I believe there were some prizes that were distributed. We had winners last night. Now, unfortunately, one of the winners was ill and couldn't make it last night, and we'd love to give him his prize today. If he is here, is Mr. Atif bin Hassina here? Yes. Mr. Atif, you've won a prize. Can you come on stage and receive it? Mr. Mohammed, can you do the honors of giving him the prize?
Good morning. Good morning.
Hello.
This is the early bird registration. We distributed yesterday, but unfortunately, it wasn't available. So today, collecting. Thank you. So just.
Hello.
We had other 5 people they received, so this is the 6th. So
thank you for all. I want to thank you very much for the invitation and the opportunity to be there with you in this honorable event. Thank you for all, and see you, inshallah. Thank you.
Thank you very much.
Thank you. I know this is completely off topic, but I have to say this. The location you were at last night, the address Montgomery, for those who are not residents of Dubai, is a great place to have an outdoor wedding or a destination wedding. Just putting it out there, and now back to the conference. So yesterday, we had a lot of inspiring dialogue and forward-thinking discussions. And today, we shall continue that momentum with a focus on the global economic outlook, technological innovation and finance, and the future of the global currency system. So let's begin our morning with our first keynote session on the global economic outlook. And to deliver this keynote, we are honored to welcome Mr. Sony Kapoor, who's an influential macroeconomist, geostrategist, and investment expert whose analysis and strategic insights have guided leaders worldwide in understanding global financial risks and opportunities. Please join me in welcoming Mr. Sony Kapoor to the stage.
Good morning. If you were expecting a bunch of slides, I apologize. I think in my 25 years of doing this, I've never once used PowerPoint slides. If you were expecting the bog standard economic outlook with numbers for each of the regions, 1 year, 5 year, 10 year, I'm happy to do that, but I don't think that's where the value added lies, right? So what I want to do instead, before I go there, can I check, because I can hear a strong echo. Is there too big an echo, or can you hear me well? It's a bit, okay. Ooh. All right. Can you turn the feedback down in the echo down? All right. Is that better? All right. Excellent. All right. So let's do this. Let's start at the beginning of this year. So most of my family is American, and I was in the States on both sides of the inauguration. Sorry, could you turn the echo down again? There's a lot of feedback and echo. Do I have to just stand there and do it, or how about now? Paul, I'm checking with you. Is this good enough or not? All right, excellent. Okay, sorry, let's begin. So beginning of this year, as in the States, on both sides of the inauguration, right? And something changed dramatically. And unlike the first sort of Trump administration, where there was a lot of news flow coming into the rest of the world, right? But you could somehow contain it. There were certain areas of interest to you in the rest of the world where what was coming out from the other side of the Atlantic was relevant, and you had to sort of just look there, right? But for the most part, you could, mostly go about your business. And this time round, the volume of the news flow coming from the other side of the Atlantic, how it affects every single thing any of you might care about, whether it's financial markets, investments in renewables, it could be technological investments, it could be defense stocks, whatever you would want to care about. There's a lot more news flow, policy actions that you just can't sort of take your eyes off what's going on the other side, because, at the end of the day, that is consequential and it affects us, right? So it is very easy to get absorbed by the news flow and get into sort of reactive mode. And I like to remind people that if you are running a successful portfolio, let's say, returning 10, 15% year after year, and you followed your portfolio on a day-by-day basis, even with a 10 to 15% return, you will get about 47, 48% of the days, you would wake up to bad news and feel a gut punch because there's a loss, right? So the frequency with which you track the news flow can be excessive and can exacerbate how pessimistic you feel. And I think that is partly what is going on in the world today. So the news flow on a daily basis is mostly not terrific. And if you follow the blow-by-blow account, you can end up with a lot of pessimism, which then becomes self-reinforcing. So let me paint a more optimistic picture of what's going on in the world, right? And I'm going to start with a controversial thesis, and then I'm going to sort of make my point and hopefully try and prove it. So my controversial thesis is this particular American administration is the best thing that could have ever happened to the rest of the world. Right? Now let me explain. So I don't know, again, how frequently you follow, with what detail, American politics, but, I know who Marjorie Taylor Greene is. I know who Laura Loomer is. I, of course, know who Steve Bannon is. I know more than any healthy person should know about the far-right MAGAverse in the United States, right? As I'm assuming, so do many of you. But if I asked you, put you in the spot and I asked you, who is the finance minister of India? I think you might have a slightly harder time coming up with a name. If I asked you, who is the vice premier of China? Who's the head of the Chinese central bank? Again, maybe it's going to be a little trickier to come up with a name, whereas Marjorie Taylor Greene and Laura Loomer just roll off the tongue, right? And this is not okay. So the United States, over the years, occupies such a massive, large proportion of our very scarce cognitive headspace that it has become completely unhealthy. It is simply not okay in our business to know who Marjorie Taylor Greene is and not be able to think of who the Indonesian, the Indian, and the Chinese finance ministers are. But that is kind of the situation we find ourselves in, right? On another front, if you follow the news, as I do, right, the news flow would have you think that all bright, shiny, amazing, innovative things come out of the United States of America, or even more narrowly, right, that most innovative things, bright, shiny stuff everybody aspires to for their country, comes very narrowly out of Silicon Valley. Well, I mean, this narrative is so dominant, right? But it has nothing to do with facts. On a factual basis, innovation of the kind that adds to productive economic activity, increases welfare, has never been as secularly widespread across the world as it is today. Again, dominant narrative, very little to do with reality, right? Number three, the US is what, 4%, 4.1% of the world's population, 2.5% of under 18s, 12.5%, 8, 9, 10% of the world's exports and imports, 15% of GDP on a purchasing power parity basis, 25% market rate, right? 15, 16% of global patents every year. And yet, 50 to 60% of the market valuation of global equity markets, 40% of listed bonds, 70% of private credit and private equity, right? Does this sound like a healthy allocation of capital, like a healthy global economy? And the answer to any basic economics 101 qualified person is no, it doesn't. It's absurd, it's insane, it's unsustainable. Now, if you spend as much time in Europe working with the EU as I did, fortunately, unfortunately, you would realize that the EU in particular, and the rest of the world more generally, we've been locked in what can only honestly be described as a toxic, codependent relationship with the United States for several decades, right? Has the EU had an independent foreign policy? I mean, maybe here and there on some minor issue, but on anything that really matters, the answer is clearly no. Has the EU had an independent defense policy capacity? And the answer again is no, not really, right? Has the EU had its best ideas, talent, innovative new firms sucked out of the European ecosystem towards the pull of very liquid, massive, much larger American capital markets? And the answer is absolutely yes, right? So this has become this sort of self-fulfilling thing, whereas the EU has been locked in this toxic relationship with the United States, where every single time we realize this is probably not that healthy, right? And in a way of a sort of Stockholm syndrome, where the kidnapped falls in love with the kidnapper, right? Every time things get a bit tense, you know, Obama comes along and wins a Nobel Prize for being Obama. And then Biden comes along and reassures everybody, no, you know, our ties are rock solid, the relationship with the UK, we have this special relationship. They're nice words, and we so want to believe that this is the United States that we've known, that we say, okay, yes, you're right, you know. So the equivalent in a relationship is, you know, somebody is a bit rough, a bit abusive, but then remembers your anniversary, gets you a nice ring, and you say all is forgiven. So this is the nature of the relationship. Now, on any sensible macroeconomic measure, the world ought to have started rebalancing away from the United States at the latest, at the beginning of this century. So that's like 25 years back, right? And instead, we have only increased dependence on multiple fronts, right? And the irony of the GFC, where I spent a lot of time working both on tackling the financial crisis and then the euro crisis was that the source and the origin was the United States. And instead of this then leading to a rebalance away from the United States, it led to even more capital allocation towards the United States, right? So every single time the US has sort of sneezed or caused or triggered financial mayhem, the end result has been even more capital being thrown at the United States. And there is a number of people out there who would think that this is kind of what's going on again, right? We are in potential bubble territory, and we just can't take our eyes off. We just continue to put our good money behind money. So the numbers are very stark. Back in 2009, the rest of the world owned about $10 trillion of American assets. Now, the rest of the world owns $30 trillion of American assets. And a large part of that is, significant valuation gains. But there has been massive amounts of capital inflows, including from this region, including from the EU, including from Asia, into the American debt, private credit, and equity markets. And this continues, right? As much as 70% of all new allocation towards private credit and private equity in the past 5 years, for example, in the rest of the world, went to the United States. And what's even bigger, of course, is that 80% of this $30 trillion is unhedged. It's just naked dollar exposure. Now, this worked fantastically well over the past many years, where you saw, as a foreign investor into the United States, this combination of outsized S&P 500 equity returns, right, combined with a strengthening dollar. The dollar started this year at the strongest trade-weighted average, I think, in more than 50 years or so, right? So it was a double boost to your returns. And this, there was no need to hedge, right? Because hedging would just reduce the returns. And the trend was clear, the dollar was strengthening, and there was no need to worry. Well, the dollar has fallen, depending on exactly which date you look at, somewhere between 8 to 9% this year. And the biggest, most stark thing you see is the sudden increase in the interest on hedging the residual dollar exposure. And of course, those of you who have traded in FX markets know that the intent, the demand for hedging, creates a further pressure towards depreciation, which then becomes self-fulfilling, right? So if the numbers are to be believed, if any substantial proportion of this dollar exposure is actually hedged, this will drive the dollar down very substantially. So maybe the best way to sort of start this is to think of basic financial assumptions that no longer hold. And I think this is the contribution of this particular administration in the United States and its gift to the rest of the world, right? So number one, Finance 101, all of us who study this, we know the US dollar is the safe currency. US treasuries are the ultimate safe asset, right? So the proxy for risk-free rates used in all financial valuations is, US treasury rates, right? More or less. So every single large institutional investor I advise, not a single one privately, very importantly, privately thinks of US treasuries as a safe asset anymore, right? So that's the first thing that has changed. Number two, this idea, which has served everybody very well, of naked dollar exposure. Most other countries you invest, you hedge, right? Naked dollar exposure, that no longer holds. Everyone I work with wants to hedge, not all, but a significantly larger proportion of their dollar exposure. Number three, not a single person I work with believes that the kind of double-digit returns we have seen in American equity markets are sustainable. They might think this can last for another 1 year, 2 years, but not a single person thinks this is going to be the case for the next 5 years or so, right? These are all three very big substantial changes. And you can already see what this has done. And this is, I think it was Ernest Hemingway who was asked how he went bankrupt. And he said something very memorable. He said, slowly at first, and then suddenly. And I think, and this is a core part of my thesis, right? I think the world is in the beginning phase of a great rebalancing away from the United States of America. Slowly at first, we are in the slowly at first phase, and then suddenly, which is potentially going to happen next year, the year after. Timing is impossible to predict, but that's the phase we are in, right? So number one, as you know, I'm British. The British economy is not doing particularly well. I was an advisor to the German finance ministry for many years, still keep close tabs. The German economy is not doing very well, right? We all know the problems in France and Italy, right? And yet, all the equity markets in these countries have outperformed S&P 500. They're booming, right? Emerging markets are booming. And it's a numbers game. So I used to advise the Norwegian government and the oil fund. So the Norwegian oil fund, which is roughly $2 trillion now, right? It has about a 50% allocation to the United States of America. So that's $1 trillion. Now, it doesn't take a genius to figure out that, let's say they decide, okay, you know what? We are perhaps overexposed to the United States of America. So the new oil money that is coming in, we are going to allocate it differently. A smaller proportion is going to go to the United States, or we just cap the absolute size of the exposure, right? Now, so large is the exposure of international institutional investors to the United States that even small changes at the margin, which don't even have to take the form of outflows, right? If you just allocate new money in a skew away from the United States, it means a potential doubling of the amount of money suddenly interested in emerging markets, right? It suddenly increases by 25% the amount of money looking to invest in other highly liquid developed country markets, be it Japan, be it the United Kingdom, be it France, etc. And that is what we are seeing, right? So just marginal changes to behavior which say, all right, perhaps this particular administration, this particular ad hocness of policy, be it on tariffs or other issues, has shown us that maybe we are far too overexposed to just this one significant idiosyncratic risk, and we need to diversify, right? And it doesn't take a large amount of money. So just going back to the Norwegian example, so even if the Norwegian oil fund decides to reduce its allocation to the United States from 50% to 40%, right? It's not that big a deal, but that's $200 billion of money that needs to be deployed elsewhere. And given that the US has 50, 60% of equity markets, 40% of bond markets, 70% of private equity markets, this sort of money at the margin can lead to significant outperformance everywhere else, which then becomes self-reinforcing, right? So that's the phase we are in. The great sort of rebalancing has begun slowly at first and will pick up pace. Now, all these other issues I mentioned, the fact that no one thinks that American double-digit returns in an economy that in an optimistic scenario will grow at 2% are going to be sustained for very much longer, right? The fact that between 100% debt to GDP ratio, continuing 6% fiscal deficits, repeated ad hoc government shutdowns, political polarization in the United States and all the rest of it, right? That US treasuries are the ultimate safe asset? Not so sure, right? And you can already see some of that. For the first time this year, you saw a decoupling of US dollar versus US Treasury, which always used to sort of behave in a safe asset direction. And for the first time, every single time there's been stress in financial markets, their behavior has diverged, right? So you can still think US Treasuries are, particularly on the longer end, may not be that safe. You might start to demand premiums to invest in 10 years and 5 years compared to the short end of the curve, right? But that's sort of behavior you're starting to see. So between the need, the demand, the latent demand for dollar hedging, the risk premiums being demanded of the longer end of US Treasuries, the fact that allocations to US financial assets are being trimmed at the margin, we are at the beginning of this great big rebalancing. So why is this excellent news for the rest of the world, right? Now, let's take a step back. So if you look at the broad sweep of economic history, economic theory, right, there are only two fundamental sources of all the prosperity, all the wonderful richness we as humanities now take for granted, right? And those are human capital, broadly defined as the potential for, you and I to contribute. And the second is natural capital, broadly defined, which includes a habitable planet, mineral, oil in the ground, biodiversity, and all the rest of it, right? Everything else, including intellectual capital, which is nothing but accumulated surpluses of human ingenuity and human creativity, right? Or financial capital, which is the accumulated surplus of past economic activity using the combination of human ingenuity and natural capital in ever more productive ways, right? Those are second-order derived things. But the first order is human capital and natural capital. Now, how do things look? So if you think of humanity as this twin-engine plane that's flying, one engine is human capital and the second is natural capital. So first, there's a pessimistic picture, right? So the pessimistic picture is, look at the demographic decline. So since 2011, the sale for adult nappies in Japan has exceeded the sale for nappies for children. So much so that this year, one of the big manufacturers of nappies in Japan decided to just shut down the business for making children's nappies, right? So it exclusively makes diapers for adults. The average farmer in Japan is about 67, 68 years old, right? We know the situation in Europe, and I like to sort of remind my German friends. So I don't know if you remember this. This is an obscure political fact. So this is about 25 years back. In the local election in North Rhine-Westphalia, right, Germany's largest Länder, where Essen is, where Cologne is, all these sort of big areas, the regional election, the CDU candidate, right, so this is not the far right, the CDU candidate, their election slogan was, Kinder statt Inder, kids, not Indians. And the background was, this is when the EU was discussing introducing EU blue cards to rival American green cards to attract talented Indian professionals, right? And the CDU's response was, kids, not Indians. And when I used to do a monthly series of lectures at the German Finance Ministry, and one of those I sort of started with, I said, well, do you remember Kinder statt Inder? And your problem is, neither did the kids come, nor did the Indians. And lo and behold, the German economy looks where it does, right? And this is a broader problem. I was having dinner with Paul last night, and you will hear from him, who lives in Japan. And he told me of this fascinating story. We were talking about Japanese immigration, where in 1990, Japan, which was facing, labor shortages, opened its economy to immigration by ethnic Japanese from Latin America, mostly in Brazil and Peru, right? And they came in large numbers. They were called the Nikkei Japanese. And it just didn't work. At the first sign of sort of economic stress, they were encouraged with great financial incentives to sort of move back. And can you imagine more alien cultures than, the samba dancing Brazilians and, in Japanese country towns. And the juxtaposition doesn't quite work. So Japan as a country has sort of decided that it's better going to sort of ride gently into the sunset with demographic decline than open doors. Not even for someone who looks like me, right? But not even to ethnic Japanese, because their experience was so alien. And as you know, by following the news, this anti-immigration backlash is happening in all of the countries that needs people who look like me the most, right? And we are the ones that they don't want. And an extreme example of that is sort of Hungary, with very strong anti-immigrant rhetoric, which I think within the EU has the biggest number of unfilled job vacancies, because they just can't quite bear the thought of having folks like me go in and sort of do their work, right? So that is the irony we are in. So the OECD in general has entered a phase of demographic decline, and every single policy child credit. I live in Norway, we have 3 kids, we get generous maternity leave. My partner is Swedish. And, we are the outlier, right? We are one of the only couples in our social circle who has 3 kids. The norm is 1 or 2. And that is Norway, right? And in Korea, the birth rate has collapsed to like 0.6, 0.7, the lowest in the world, when the replacement rate is 2.1, right? And this is important. And why is this important? This is important because if you look at post-World War II history and the fantastic, economic growth that the OECD countries went through, half of that was driven by an actual increase in the number of workers, right? And half of that was driven by productivity gains. So, when the number of workers start decreasing, you already go from growth potential of 4 or 5%, observed growth rates of 4 or 5% that Germany saw for many years, for example, to an optimistic scenario where the shrinking workforce is dragging the GDP down and productivity is also stagnating, which is a different question, right? In a good scenario, we expect EU economies to grow at, 1.5%, right? The US will grow at 2% or so. Now, all of this is well and good, but if your pension fund has 85% of its investment in Japan, the United States, European economies, right? And to be viable, you expect annual returns of 6 to 8% in economies that in a good year will grow at 1 to 2%, you begin to see the problem, right? So that's the return side. So the upside potential of our Western savings being deployed mostly in rich economies has fallen off the cliff. At the same time, right, Finance 101, they teach you, do not put all your eggs in one basket. It's a simple thing, right? And here we are, having put all our eggs in a basket of countries which have very high levels of financial and economic interlinkages, right? Which are facing similar challenges, structural challenges of demographic decline, rising debt, political polarization, and in a place like the Eurozone, the spillovers from a crisis in France into Italy, from a crisis in Italy into France and Germany, etc., are massive, right? So this is the exact opposite of Finance 101. We have, broadly speaking, in our large institutional investors, including the Norwegian oil fund, right, chosen to put most of our investments where we have locked in low and falling returns, expected returns, in high and rising and highly correlated risk, right? So this is up is down and down is up and black is white and white is black. That's the world we live in. So this is why what I started with a gratitude, a word of thanks to the present administration in the United States, because it has taken something as drastic as this administration. It has taken this volume of news flow. It has taken the ad hocness of punishing allies and rivals through tariffs, which change every other week. It has taken assassinations, extrajudicial assassinations, be it in Yemen or in the Caribbean now, right? It has taken all of these put together to wake up the rest of the world to say, hey, maybe, there's a whole world out there. And what I haven't mentioned yet, which is very, very germane and relevant, right, is the following fact. Because we have limited cognitive headspace and because this American dominance narrative is just so dominant, right? So over the past 25 years, I've advised roughly 100 asset owners, asset managers. And I've made it a principle. I don't know, can I just see a show of hands? How many of you are familiar with Hans Rosling's work? Are there people who know Hans Rosling's work? All right, okay. Okay. Hi, hey, Mom, nice to see you. All right. So, he was a Swedish epidemiologist, an old friend of mine who sadly passed away. And he started teaching a new class in Sweden. And he just wanted to, before he started teaching, get a baseline idea of how much his students knew, right? And these are the sharpest, most competitive students in Sweden. And so he asked things like, okay, what do you think? Multiple choice question. What is the birth rate in Bangladesh, right? Is it 5? Is it 2? Is it 4? Stuff like that. What is the life expectancy in sub-Saharan Africa, right? What percentage of students in South Asia finish school? So questions like that, just to get a rough idea. And he realized that the smartest students in Sweden, who went to the Karolinska Institute, Sweden's premier health institute, right, did worse than monkeys. So their notion of the world was so outdated with the rough idea, Africa risky, developing world shit, and, rich world around. That was sort of the rough idea. And to give an example, so I have created my own customized version of the Rosling quiz that I administer to everybody I advise, whether it's corporate boards, investment committees, the Norwegian Oil Fund, or, as I often do, when I advise cabinets and diplomats, right? And all these people are people who, because of their professions, and some of these asset managers have been emerging market specialists, right? Really should know, should have a more updated view of the world. And they all do worse than monkeys, right? And let me just dwell on one example. So, if you still think, as most asset managers in Europe do, that the birth rate in Bangladesh is 5, right? It's not just about the birth rate. It comes with this whole idea, Muslim country, birth rate of 5, and all the other, biases that go along with that, right? Whereas the birth rate in Bangladesh, a non-negligible country, we're not talking about Lesotho, right? I mean, this is a country of 200 plus million people. I think the third or the fourth largest Muslim country in the world, which against the odds, despite being very poorly endowed in natural resources, right, has been growing at 6 to 7% despite horrible politics year after year, a huge success story, right? Amazing increase in life expectancy, etc. And these people who call themselves emerging market specialists or the diplomats in, Sweden or the EU or Norway, most of them still think the birth rate is 5, which it hasn't been for more than 25 years, right? It's 2.1 or something. And if you just use that as an example and realize if this is what they think of a country that has a population, not that far from the EU or the United States, right? What do they ever think about sub-Saharan Africa, right? Are we ever going to realistically expect these people to allocate capital as it should be, efficiently, with full knowledge and due diligence to where the biggest opportunities are? And the answer is absolutely no. And so, again, because of the dominant narrative, because of the limited cognitive headspace, because I know who Laura Loomer and Marjorie Taylor Greene are, these are the very reasons I don't know what the birth rate in Bangladesh is, right? I don't know how much advances in technology, in human capital development, India has made, right? It is the very reason that I get surprised in Europe. Whenever I tell people, and the response is just mind-boggling. When I tell them that, and I go out with my kids to Delhi, and I'm going to buy an ice cream for 10 rupees, which is like one cent, right? They want to be paid digitally, right? Before my parents died, and they were in their mid-80s, 90% of their interactions with the tax authorities, with the banking system, with the government were done on their mobile phones, right? In Germany, it's still impossible to go out anywhere and be served in a restaurant without actually having cash in your wallet, right? What was up is down, what is down is up. So the biggest, most important contribution of this particular state of the world we are in, which on a day-by-day basis doesn't look great, right? It's a bit depressing. It feels like a gut punch. Things are very uncertain. Who knows what tomorrow will bring? It is waking up the rest of the world to look away from the United States towards where the majority of the world's population lives, towards where all efficient allocation of capital opportunities mostly lie. And these opportunities are amazing. Let me give you a few examples, right? So I stepped down recently from the EUI. The EUI is one of the EU's premier universities, the European University Institute in Florence. And I was an interdisciplinary professor of geoeconomics, finance, and climate. And I advised a few G20s over the years, I think 6 of them, partly in that role. And what I was trying to do was to answer the question of, where does future global growth come from? So perhaps this is a relevant time to sort of talk about it briefly. I just want to double check I'm doing okay on time. Yes. I will finish in about sort of 5 minutes or so, and then hopefully there'll be some time for Q&A. So for every country facing steep demographic decline, we need to remember that the world as a whole doesn't have a demographic challenge, right? There are 25 million Indians and sub-Saharan Africans coming into the workforce every single year, only a small fraction of whom will even be employed in the formal sector, leave alone having the best opportunity to be the best version of themselves, as luckily all of us in this room do, right? There has never been so much untapped human capital. And remember I said this was one of the big sources of all economic growth we take for granted, right? So the world has never had as big a stock of underemployed human capital as exists today. And yet all our headlines in the West are dominated by labor market shortages, demographic decline, right? So now what's also clear is, Kinder Start-Inder, we in Europe, in the United States, don't want the Mexicans and the Indians and the Africans to come here anymore. And that's okay. And that's okay, partly thanks to Corona. So, COVID was horrible. I lost friends, some family, as I'm assuming you did too, and I apologize for that. But there was one amazing piece of news that came out of it, right? So apparently Zoom had existed before. I didn't know about it. I remember when I started at Lehman Brothers about, 25, 26 years back. The first day we entered these grand big video conferencing rooms, which were perfectly well equipped, except nobody used them, right? All the meetings were done in face-to-face. But peak lockdown, 2/3 of American GDP and 2/3 of European GDP was delivered remotely, right? That was not equilibrium, clearly. But there is no reason why 1/3 cannot be. And if it can be done from across the street, it can be done from across the ocean. Now, if you look at the last golden age of globalization, between sort of the fall of the Berlin Wall and China's entry into the WTO, so what was it that drove the successes? The low inflation, the massive boost to growth, the massive reduction in poverty, all the fantastical things that happened. Now, one way of thinking about it is that the biggest driver of that was a doubling of the number of workers engaged in globally productive supply chains in goods. Okay? Let me repeat that. In goods. Now, goods are 20, 30% of our GDP and shrinking. Services are 70, 80% of our GDP and rising, right? We have a globalized economy in goods. We do not have a globalized economy in services. And what Corona did was it normalized the remote delivery of high value-added services. And the opportunities from a growth model that is able to use this record demographic asymmetry between declining West and a massive young population in Africa and South Asia are huge. And we've estimated with work we did at the LSE and the EUI that the potential boost to the global economy through this globalization of services is twice as large as what we saw with the last golden age of globalization, right? Which was miraculous and remarkable and unprecedented in modern economic history. And so, and what's very important there is that the environmental footprint of an equivalent value added of export of services versus goods is about a tenth. So with all the real worries about climate change, it is possible to reconcile a massive boost in global trade in cross-border services, which partly addresses the demographic challenges, boosts growth both in emerging economies and in the West, is able to be reconciled within an increasingly constrained environmental boundary, which is very important, right? And the reason it's important, to give an example, so when I was advising the Indian G20, one of the things that came up was the growth model, right? So up until now, recently, every country larger than Singapore or Dubai that has sort of, or UAE, right, that has developed through the export-led manufacturing growth model, be it China, Japan, Korea, and so on, with very large environmental footprints in domestic infrastructure and internationally, right? Now, if India goes down the same path, if India reaches even half the resource intensity that China has today, the world overshoots 3 degrees. So the rest of the world cannot allow India to follow the export-led manufacturing growth model, and India cannot afford not to do that absent an alternative. And this is the alternative, right? So, to sum up, the near-term growth rate, I think we're okay. The global economy is doing better than expected against all the shocks, right? And trade volumes haven't really shrunk. It sort of continues. So I think the near-term growth rate is still 3.5%. You know, the EU will go along, the UK and the EU at 1.5%. This region doing, you know, relatively okay, not amazing, but 3.5%. Sub-Saharan Africa, 4%, and the Indian and Asian poles are still doing well. 6, 5, 5.5%. China sort of 4.5% or so, right? But it is the midterm, the 2030 projection. It is the 2035 projection that I'm interested in. And there, I see global growth rates, if this great rebalancing continues and investments are allocated to where the people are, where the biggest infrastructure gaps are, where the biggest opportunities are, is going to be significantly higher. So I think, and we have agency, right? We have capital, we have skills, and this part of the world is especially important both in terms of where we put our capital, and second, in terms of the expertise that we have on South Asia, on Sub-Saharan Africa, on Asian regions, in order to be allocate capital in a knowing way. We are not the people who think the birth rate in Bangladesh is 5, right? We're people who see the opportunities and can put money where our, put our mouth and money in the same direction. So, in summary, ignore the continuing flow of uncertainty, bad news, unpredictable events, etc. Against the odds, this is the best thing that could have happened for the global economy, whether you're a red-blooded capitalist, as I am, or not. capital can, must, and will now go to where it can be most productively deployed, develop human capital, boost global growth rates, diversify our investments, and make sure that the world has multiple growth engines and is not over-dependent on the idiosyncratic risk of one election in a certain part of the world. Questions, please.
Thank you very much, Sony. What role do you think AI plays in all of this?
I'm sorry?
What role do you think artificial intelligence is going to play in all of these
sure,
geopolitical dynamics?
Yeah. So, so by background, I'm one of those engineers from the Indian Institute of Technology who wasted my life in finance, but science and technology remain my first love, and I follow it closely. I think it's most likely, so it looks bad, right? Because it looks right now that there's this huge polarization of concentration of wealth, particularly with those who own various AI proprietary technologies, who founded ChatGPT and so on and so forth. But I think the longer term outlook is far more benign, and that sort of has the great equalizer in the same way that Google allowed a secular access to the global vast pool of knowledge. I think AI is going to be the great equalizer in everything, from partly reducing, linguistic barriers, right? So one barrier to my thesis of cross-border delivery of high value-added services was, language, right? But we are now already seeing real-time quality translation happening. We are seeing access to amazing resources that is quite secular. In fact, many of these AI firms have provided free access through many of the Indian mobile services providers, right, in a way they haven't done in any other country, and they recognize it. So I think that AI, in the context of the thesis I painted, is going to be a great equalizer. And just as with previous bouts of innovation, whether it was railroads, whether it was, broadband cables that were laid out, etc., there's going to be a lot of infrastructure build out, and those who are responsible for building the infrastructure, who own the proprietary IP right now, will not be the biggest beneficiaries. That the biggest beneficiaries will be vast majority of the world's population, and it's the relative benefits that count. So I think of AI as the great equalizer, and I do not worry, at least not yet, about massive unemployment, potential job losses, etc., or a sudden disappearance of job opportunities in the emerging world. That might come, but for the near future, I think this will enable these people to get onto the globally productive supply chain in high value-added services. More questions, please? I think I have 1 minute left. Yes, please. There's two. Can I take both questions together since there's just two? Yes, please.
Sure, yes. Thank you, first of all, for your session. I'd just like to ask, I'd love to understand your view. You mentioned that the world is in the beginning of rebalancing away from the US. I just want to understand your views. Where do you think it's heading? And I'm sure it's rebalancing to other dominant countries around the world, probably China or whatever your view is. And how long would you estimate that period would take?
Okay, sure. There was another question back there, maybe. Yeah.
Yeah, thank you, Sami, for an insightful perspective. I think my question aligns with the earlier question. Just want to say the US have been able to attract this capital because they have transparency, deepened financial market, rule of law. What country do you think can take this? And how long will it take for us to deploy capital to those countries you're referring to? We all agree that US is in high debt. There's need for a rebalance. But what country is ready to take that next move? Thank you. And how long?
Sure. Okay, let me try and address both those questions together. So number one, right? I mean, finance is about relative risk and relative return. So just in case someone misunderstood, I'm not dissing the United States, right? It remains an amazing place. Most of my family is American. I've lived there. I go spend a lot of time, you know, all the rest of it, right? But what is inescapable is that the relative risk of the United States, whether it's political, whether it's institutional decline, whether it's financial risk, whether it's fiscal risk, whether it's the independence of the Fed, you know, whatever components you want to look at, the relative risk of the United States has risen, right? And for reasons I mentioned of, you know, the unviability of double-digit stock market gains, which mostly are explained by one-off factors that included a halving of corporate tax rates from 40 to 20%, massive amounts of QE, a secular decline in interest rates until recently, right? Those factors, those tailwinds have either become headwinds or have stopped being tailwinds, right? So the relative returns in the US have fallen, the relative risk has risen. Now, relative to what, right? And here my thesis is relative to the emerging world. Now, let me explain. So, you know, think of a basket of Brazil, Indonesia, India, some Southeast Asian economies, you know, South Africa, Nigeria, a bunch of emerging economies, right? So clearly, each of them individually, you can say, oh, this is riskier than Germany. This is riskier than France. This is riskier than the United States, right? And first, that's becoming less and less, you know, justifiable given the number of prime ministers that, you know, France has had recently, given the number of government shutdowns in the US, et cetera, right? But let's go with that. Okay. But what is inescapable is a portfolio of emerging economies that have relatively limited economic and financial interlinkages with each other, right? Is there a reason that, you know, government instability in Indonesia might cause a recession in Brazil? And the answer is, I don't think so, right? Is there a reason that, you know, French instability might cause instability in Italian government bonds? Absolutely yes, right? So the interlinkages between these economies are much weaker, which means a portfolio of emerging economies with different political systems, different structures of economy, different drivers of growth, you know, is increasingly looking far safer, even on an absolute basis, than a portfolio of mostly EU, Japan, and the United States, right? So that's a sort of big thesis. Now, again, it's the relative risk and relative return that matters, but another thing matters. So when someone shows me a series of projects and, you know, to make an investment decision, I don't think of them independently, right? I look at my portfolio and I say, how well does this fit in with my existing portfolio? Now, it may be that if my portfolio had 50% emerging markets, 50%, you know, rich developed world, right? Then I would say, okay, well, you know, my portfolio is balanced, so let me evaluate this project, then this has slightly higher returns, so this is what I'm going to go for, right? But we are at a situation where 85 to 90% of my portfolio is mostly rich economies, and if you show me a way of allocating my next $1 billion either to more S&P 500 tracking, or you show me an infrastructure project in India that has very different characteristics, very different drivers of returns from my already heavily overexposed, you know, portfolio to American stock markets, then this clearly looks more attractive, right? So from where we are on a portfolio basis, and with these changes in relative risk and relative return, I expect that we are going to see a significant growth in investments, both listed and unlisted, in a portfolio of emerging economies. The list will change. Nigeria will come in. Nigeria will go out of the list. India will be fashionable. India will be less fashionable. But by 2050, we will easily have arrived at a time where the financial asset stock, be it listed, unlisted, debt equity in emerging markets, is likely to be significantly larger than the financial assets in developed economies. And right now, I think the US share is twice that of all emerging markets put together. I saw a Goldman Sachs projection. I don't always agree with Goldman Sachs, but on this I do, that by 2050, it might even look the other way around. So that's roughly how I think things will go. I fully expect some of this rebalancing to already be macroeconomically consequential by 2027, 2028, and roughly half of this in the near term to have already happened within the next 10 years or so. I hope that answers the question. Thank you.